The truth that traders spend their whole lives trying to outrun is the simplest one of all. The market never changes. You can alter the language, the tools, the charts, the screens, and the news feeds that flood in at the speed of light. But beneath the glitter of modern technology lies the same beating heart it always had. Human nature does not evolve at the pace of machines. Fear does not need an upgrade. Greed does not require a faster server. Panic has no version number. The emotions that drive men to put their last dollar on the table, to buy when they should sell, to hold when they should run, remain the same as they were when orders were written on slips of paper and shouted across a crowded pit. If you sit long enough and watch, the illusion of novelty falls away. A chart today may glow on a high-resolution screen, but the story it tells is no different than the old ticker tape scrolling across the broker's office. The lines climb, they falter, they collapse, and then they rise again. It is always a mirror reflecting back the impulses of thousands of minds, each one certain it is acting rationally while being swept along by collective psychology. A trader who understands this does not need to chase every new indicator, every novel theory, every voice that claims the market has changed forever. What he needs is the patience to remember that the crowd, in all its noisy forms, behaves in predictable ways, because people themselves never change. Consider fear. When markets break hard and fast, fear spreads like fire. Screens flash red, brokers call in panic, and the man who yesterday was boasting of his position suddenly wishes only to escape. It was true in 1907, in 1929, in 1987, in 2008, and it will be true again. Fear is timeless. It makes men sell their holdings for less than they bought them, even though nothing in the company has changed except the crowd's mood. Fear drives liquidation at the worst possible moment, turning paper losses into permanent ones. The forgotten rule is that a trader must learn to see fear for what it is, not a signal from the market, but a signal from within the human heart. Recognize it in others, and you can profit. Recognize it in yourself, and you can survive. Then there is greed. The twin to fear, it operates with equal force, but in the opposite direction. When prices rise day after day, the crowd forgets that markets can fall. Every man believes himself wise, believes the rally is endless, believes that the fortune already made is only a fraction of the one to come. He adds more money, takes greater risks, and convinces himself that the higher it goes, the safer it becomes. Greed blinds a trader to risk, dulls his memory of past crashes, and lures him into holding far longer than sense dictates. Just as fear makes men dump bargains into the market's hands, greed makes them pay absurd prices for scraps, feeding the very bubble that will burst and ruin them. A trader who remembers that the market never changes will see greed not as opportunity but as warning. When the crowd feels invincible, the turn is near. Hope is the softer cousin of these two, but no less destructive. Hope whispers when the tape screams. A man buys, the stock falls, and rather than cut his loss, he hopes. He hopes the market will reverse, hopes tomorrow will bring recovery, hopes that by ignoring the tape he can bend it to his will. But the tape does not bend. The market does not listen. Hope has ruined more traders than fear and greed combined. Because it works in silence, slowly, eating away at discipline until the account is destroyed. To understand that the market never changes is to understand that hope is not a strategy. The forgotten rule is that the tape is always right, and your opinion, no matter how stubborn, is always wrong. If it disagrees with price panic, of course, is fear magnified by speed. It is the moment when the crowd's emotion breaks through the surface and becomes visible in every man's action. Panic selling is contagious. It spreads not because of logic, but because of instinct. Like a herd of animals bolting from an unseen predator, men sell simply because others are selling. It was panic that created the great crashes, that sent men leaping from windows, that wiped out fortunes in days that had taken decades to build. Yet panic also creates the great opportunities, because when everyone is rushing for the exits, value is being thrown away. The trader who knows that the market never changes does not join the stampede. He watches, waits, and prepares to buy when others have exhausted themselves in their madness. What does this truth mean in practice? It means that while methods and strategies evolve, the core principles remain eternal. Charts, systems, and indicators are merely tools to interpret human behavior. They are not the source of profit, they are the lens through which profit can be glimpsed. If you mistake the tool for the rule, you are lost. The rule is that markets rise and fall on the tides of human emotion, and those tides do not change. To profit is not to predict the future, but to recognize the present. The forgotten rule is not about inventing something new, but about remembering what has always been true. A trader who studies history learns this lesson again and again. The panic of one century looks exactly like the panic of the next. The charts of old booms are indistinguishable from the charts of new ones. It is almost comic to watch each generation believe it is witnessing something unique, something unprecedented, something that history cannot explain. Yet when you strip away the names, the dates, the industries, the currencies, the graphs, tell the same story, people chasing prices higher until they collapse under their own weight. People selling in despair until the market is so cheap it cannot go lower. People repeating the cycle because memory fades and emotions rule. If you were to blindfold a trader and show him a chart from 100 years ago and a chart from yesterday, he could not tell which was which. The swings, the trends, the spikes, and the plunges are identical. That is the proof that the market never changes. It is not a machine of numbers. It is a mirror of men. And men, no matter their technology or sophistication, remain bound to the same weaknesses. The great mistake is believing that because the world has changed, the market has too. But the market is not the world. It is the psychology of the people in it. Technology may accelerate the speed, but it does not alter the direction of human impulse. The forgotten rule is that if you master the crowd's timeless emotions, fear, greed, hope, and panic, you master the market itself. To ignore this is to be lost in noise, forever chasing shadows, while the real truth lies in plain sight. The market never changes. The hardest thing in speculation is not finding a stock to buy, nor is it placing the order at the right time. The hardest thing is doing nothing after you have acted. Men believe they are made for action. They think in terms of movement, of busyness, of constant tinkering. They confuse motion with progress, trades with profits, noise with opportunity. But the real money, the kind that builds fortunes and breaks records, was never made in the noise. It was made in the silence, in the patience of waiting, in the discipline to sit tight while the market does the work. The forgotten rule is simple. It is not enough to be right about direction. You must also have the strength to stay with it. Anyone can guess that a stock might rise. Anyone can buy into a move. But when the stock begins its climb, most men grow restless. They watch every tick. They second, guess every fluctuation. They whisper doubts into their own ears until they talk themselves out of the very position that could have changed their lives. They take small profits out of fear that the market will reverse, and in so doing, they cut off the chance of capturing the large movement that only comes a few times in a career. Fortunes are built not on dozens of tiny wins, but on the handful of great trends that are ridden to completion. The trader who buys right and then sits tight is rare because sitting tight requires something most men do not have: the ability to control their own impulses. It feels unnatural to sit still while the tape dances, while rumors fly, while the crowd around you is selling in one breath and buying in the next. Yet to sit still is exactly what the rule demands. Patience is not the absence of activity. It is the mastery of it. To wait when waiting is hardest, to trust your position when every voice calls you a fool, to see past the noise to the larger swing. That is the discipline that separates the fortunate few from the countless many. There is a cruel irony in trading. Men will endure endless labor to study systems, charts, and numbers, yet they cannot endure the simple task of waiting. They believe intelligence alone makes a fortune, when in fact intelligence without patience is like a ship without an anchor. It may leave the harbor, but it will not survive the storm. The discipline to hold is not glamorous. It does not flatter the ego. There is no applause when you simply do nothing. But the market, silent and impartial, rewards it with profits beyond the reach of the restless. Consider the alternative. A trader buys a stock that begins to climb. Within days, it rises modestly, and fear creeps in. He sells, satisfied with a small gain, and congratulates himself for being prudent. But the stock continues its ascent, rising higher and higher, doubling, tripling, rewarding those who remain steadfast. The trader watches in agony, realizing that his impatience has cost him far more than any loss ever could. A small gain feels safe, but it is the thief of the great profit. The forgotten rule whispers that the big money is not in the buying or the selling, but in the sitting. This rule applies not only to profits but to survival. The market tests a trader's nerve as much as his intellect. A position will not rise in a straight line. It will fluctuate, retrace, and threaten to shake you out. Every retracement is a test. Will you hold, or will you flee? The crowd flees because the crowd cannot bear uncertainty. They crave certainty in a world that offers none. But the trader who understands the importance of sitting tight does not seek certainty. He seeks probability. And he knows that probability only plays out over time. To demand immediate reward is to sabotage yourself. To allow time to work in your favor is to obey the rule that has always separated the successful from the ruined. There is a story told in the charts of every great trend. At the beginning, only a few recognize it. In the middle, many are aware but uncertain. At the end, everyone sees it, but it is too late. The men who profited most were not the ones who identified the trend at the start. They were the ones who had the patience to ride it through the middle and into the end. The act of sitting tight, of resisting the urge to take quick profits, is what allowed them to be present when the largest gains occurred. The forgotten rule reminds us that the market does not reward impatience. It rewards endurance. To sit tight is not the same as being idle. It is not a matter of stubbornly holding every position. It is a matter of buying correctly at the right time, and then allowing the trade to fulfill its potential. Sitting tight is not about denial. It is about confidence born from preparation. You cannot sit tight if you entered recklessly. You cannot sit tight if you do not trust your judgment. You cannot sit tight if you are ruled by fear. But if your position was chosen with care, if your entry was deliberate, if your conviction is grounded in reason, then the greatest act of discipline is to step aside and let the market prove you right. The world will tempt you otherwise. The noise of daily fluctuations will whisper doubts into your ear. The news will scream crises. The crowd will chatter of reversals. Every pullback will feel like the end. Every rally will feel like a trap. It is here, in the storm of uncertainty, that most men sell too soon. But the rule demands endurance. You must learn to sit tight when sitting tight feels unbearable. You must learn to watch profits grow and shrink and grow again without the constant itch to interfere. The market will do the work for you if you let it, but only if you stop trying to wrestle with every tick of the tape. There is a discipline even deeper than patience. It is the discipline to resist your own ego. Men want to act because action flatters them. It gives the illusion of control. They want to buy and sell, to boast of their clever entries and exits, to tell stories of how they captured this point or that point. But the man who sits tight has no stories to tell. He simply has results, and in the end, it is not the chatter of clever trades that builds a fortune. It is the quiet of waiting through the storm, of enduring the test, of holding when others could not. The forgotten rule is that sitting tight is harder than any calculation, any prediction, any trade. It is the rule that demands the most from a trader's character, and gives the most in return. The men who broke records, who turned small stakes into great fortunes, did not outsmart the market in every tick. They mastered themselves, and in mastering themselves, they mastered the only task that matters, to buy right, and then sit tight. In speculation, the difference between those who last and those who are erased is not brilliance, not luck, not even timing. It is the ability to take a loss without hesitation. The forgotten rule is simple, yet it feels unnatural to most. When you are wrong, You must admit it quickly and act decisively. No excuses, no hoping, no bargaining with the tape. A small loss taken swiftly is a lesson. A large loss nursed with denial and fed with hope is a disaster. This rule has ended more careers than ignorance ever did, because men can learn knowledge, but few can learn humility. The market has no mercy for the man who clings to a losing trade. Prices fall, and instead of cutting loose, he invents reasons to stay. He tells himself the market will turn. He says the stock is oversold. He listens to rumors that promise recovery. He adds to his losing position, convincing himself he is averaging down. In truth, he is not averaging down. He is compounding his error. He is trading not against the market, but against himself, against his fear of being wrong. Every tick lower is not just a loss of money. It is a wound to the ego, and so he holds, bleeding slowly, until the loss becomes unbearable, until he has no capital left to trade. Why does this happen? Because hope is a seductive enemy. When a man buys a stock and it falls, he feels betrayed. The tape mocks him. His pride aches. Instead of admitting error, he resists the only logical step. He cannot bear to close the position because closing it means admitting failure. And so he hides behind hope. He tells himself tomorrow will be different. The market will reverse. The loss will vanish, if only he waits long enough. But the tape is not a wish granter. It is indifferent. It moves according to supply and demand, fear and greed, never according to the personal hopes of one trader. The forgotten rule is that hope is poison, and once it enters a trade, the only cure is swift, merciless action. Cutting losses is not merely about protecting money. It is about protecting judgment. Every dollar lost weakens the trader's confidence. The longer he holds, the more desperate he becomes, until his decisions are driven not by logic but by emotion. When you cut quickly, you preserve your clarity. A small loss today keeps you in the game tomorrow. A large loss clouds the mind, saps the will, and destroys the courage needed to seize the next opportunity. Survival in speculation is not measured by the brilliance of one trade, but by the ability to endure for the long run. The man who cannot cut losses will not endure. There is a saying, losses are tuition. Every trader pays them. They are the cost of learning, the price of admission to the market's truths. But like all tuition, their value depends on how quickly you pay them. If you pay at once, the lesson is sharp but affordable. If you defer payment, if you drag out the loss, the interest compounds until the debt consumes you. What might have been a small fee for a mistake becomes a ruinous debt that leaves you broken. The forgotten rule is that losses do not shrink with time. They grow. To wait is to pay more. To act is to save yourself. The discipline of cutting losses is also the discipline of respecting the tape. The market tells you when you are wrong, but only if you are willing to listen. The tape does not lie. It does not care about your theories, your research, or your conviction. If the price moves against you, the market is giving you a verdict, and the verdict is guilty. A wise trader accepts the sentence and steps aside. A fool appeals, argues, resists, and in doing so, makes the punishment harsher. To cut losses quickly is to bow to the authority of the tape. To refuse is to declare war against an enemy that cannot be defeated. Some men confuse cutting losses with cowardice. They think it shows weakness to admit defeat. In truth, it shows strength. It takes courage to abandon pride, to sever hope, to walk away before the pain becomes unbearable. The coward holds on, hiding behind excuses. The brave man closes out, preserves his capital, and waits for the next fight. A trader who can cut losses without hesitation is a trader who can last a lifetime. The one who cannot will not last a year. The act of cutting losses must be mechanical, not emotional. If you wait to feel ready, you will never act. The market does not wait for your comfort. You must decide beforehand, with cold clarity, where the line is drawn. When that line is crossed, you act instantly. No hesitation, no reconsideration, no pleading with yourself. A loss that violates your rule must be cut at once. It is not negotiable. Discipline means treating every loss the same. As a fact, not a debate. This is why so many fail. They treat trading as a matter of feelings instead of rules. But speculation is not a place for feelings. It is a place for execution. There is another danger in not cutting losses, the missed opportunity. While you are trapped in a sinking position, your money is locked. You cannot use it for new trades. The market may offer golden chances, but you cannot take them because your capital is chained to a corpse. By refusing to cut a small loss, you not only destroy your account, you forfeit the profits you could have earned elsewhere. This is the hidden cost of stubbornness, not only the loss you take, but the gain you miss. A trader who cuts losses swiftly frees his capital to chase better opportunities. The man who does not is a prisoner of his own mistakes. History is filled with examples of traders who rose and fell. The pattern is always the same. Those who survived understood this rule. They cut their losses without hesitation, and so they endured. Those who perished ignored it. They held on too long. They added to losing trades. They convinced themselves the market owed them a reversal. The market owed them nothing. It collected its debt in full. The forgotten rule is that the market punishes the man who hesitates. It rewards the man who acts swiftly, without sentiment, without pride. The act itself is brutal but clean. It is like cutting away a poisoned limb. You save the body by sacrificing the part. The loss may sting, but it preserves your future. To cling to the limb is to risk the infection spreading until the whole is lost. Traders who cannot see this are doomed to ruin. Traders who accept it learn the art of survival. Cutting losses without hesitation is not glamorous. It does not inspire stories of genius. No one brags about the trades they abandoned at small losses, but every fortune in speculation rests upon this unglamorous habit. The rule may be forgotten by the crowd, but it is remembered by every survivor. To obey it is to endure, to ignore it is to be erased. The market is a teacher that never speaks in riddles. Its language is plain, its verdicts are absolute, and its justice is swift. The only mistake is believing you know more than it does. Many men have entered the market armed with theories, predictions, and convictions, only to discover that the tape does not care. The forgotten rule is clear: never argue with the tape. When price speaks, it is the only truth that matters. All else, your opinions, your hopes, your forecasts, are noise. The tape is the pulse of the market. Every tick is a record of human action, a balance between supply and demand, between fear and greed, between the countless emotions of the crowd. It is not abstract, not theoretical. It is the raw, unfiltered outcome of millions of decisions, all distilled into a single number that moves up and down. That number is reality. To deny it is to deny gravity. A man who ignores the tape is not a speculator. He is a dreamer, and the market destroys dreamers with efficiency. Why, then, do so many argue with it? Because pride blinds them. A man studies, researches, and convinces himself that he knows what should happen. When the tape moves against him, he does not admit error. Instead, he insists the tape is wrong. He clings to his theory, believing the market will eventually agree with him. But the market does not agree or disagree. It moves. The tape is never wrong, and by refusing to accept that, the trader turns a manageable mistake into a fatal one. He is not fighting the market. He is fighting himself. And the tape always wins. Every trader has felt the sting of this lesson. You buy, convinced of a rally, but the tape slides lower. You sell, certain of a collapse, but the tape climbs higher. Each tick against you feels like an insult, and pride whispers, "Hold on, it will turn." But the forgotten rule says otherwise. The tape owes you nothing. Your conviction means nothing. If the price action contradicts your belief, then your belief is wrong. To resist is to bleed. To accept is to survive. There is wisdom in silence. The tape speaks in movements, not in words. And those movements reveal the crowd's state of mind. Rising prices tell you where demand overwhelms supply. Falling prices tell you the opposite. It is not a mystery. It is a mirror. Yet men insist on overlaying their own opinions, interpreting the tape through the lens of their desires. They want the market to confirm their genius, and when it does not, they argue. They write long explanations. They consult experts. They search for hidden reasons. But all the while, the tape is telling them the truth in the simplest form possible. The price is moving against you. That is all you need to know. The strength of a trader lies not in predicting the market, but in obeying it. Prediction is prideful. Obedience is humble. The forgotten rule teaches that the tape leads and the trader follows. When the tape changes direction, the wise man changes with it. He does not cling to yesterday's opinion. He does not demand to be proven right. He moves with the market, not against it. This humility is the source of survival and the foundation of profit. Consider the great crashes. Before each collapse, there were men who insisted the market was strong. They pointed to earnings, to politics, to interest rates, to every argument under the sun. But the tape began to fall, and that was all that mattered. Those who listened escaped. Those who argued were buried. The market does not announce its reasons before it moves. The tape does not explain itself. By the time the reasons are written in the newspapers, the move is already finished. The forgotten rule is that price leads. Explanation follows. If you wait for the explanation, you are too late. The tape also reveals something deeper. The weakness of human nature. Men want to be right more than they want to be rich. They will cling to a wrong trade, defending it with words, because to close it would be to admit error. They argue with the tape as though it were an opponent they could outwit. But the tape is not an opponent. It is the scorekeeper. To argue with it is to argue with the judge who calls the match. You may not like the call, but it is final. The sooner you accept it, the sooner you can return to play. The discipline of never arguing with the tape requires killing pride before it kills you. It requires treating the market not as a stage for your opinions, but as a master to be obeyed. This is why so few can follow the rule. They believe intelligence entitles them to be right. But speculation is not about intelligence, it is about discipline. The tape does not reward cleverness, it rewards humility. The forgotten rule is that you can never impose your will on the market. You can only align with it or be crushed by it. When you learn to obey the tape, the noise of the world grows quiet. Rumors, headlines, forecasts, speeches all fade into irrelevance. They may stir the crowd, but their effect is already captured in the tape. If the news is bullish yet the tape does not rise, then the truth is bearish. If the news is bearish yet the tape does not fall, then the truth is bullish. The tape absorbs all information and delivers a verdict before you can think. To ignore it is madness. To obey it is sanity. The beauty of the tape is its simplicity. It does not require prediction, only observation. It does not demand theory, only acceptance. The forgotten rule frees you from the burden of trying to outsmart the world. You do not need to know why. You only need to know what. The tape tells you what. Price is reality. Your job is not to question it, not to fight it, not to argue with it. Your job is to act in harmony with it. The market is a mirror of mankind, and the tape is the reflection. To argue with it is to argue with the very nature of reality. Those who understand this rule live to trade another day. Those who resist learn the lesson the hard way, paying with their fortune, and sometimes with their peace of mind. The forgotten rule is merciless, but it is fair. The tape never lies, and it never changes its nature. The only choice is whether you will accept its truth or waste your life resisting it. The market offers endless temptations. Every day brings a flood of opportunities, each one flashing like bait in the water, each one whispering promises of quick profit. Most traders scatter their efforts across these distractions, taking a little here and a little there, convinced that spreading their bets will bring safety. They confuse diversification with wisdom. In truth, it dilutes not only their money, but their attention, their discipline, and their chance at greatness. The forgotten rule is that fortunes are not built by chasing every move. They are built through concentration, To strike with size in the right stock, at the right time, with unwavering conviction, is the way wealth is forged. The crowd believes in safety through numbers. They scatter their capital across dozens of trades, never committing fully to any one of them. But by doing so, they commit fully to nothing. They ensure that when the rare, great opportunity appears, they are too thinly spread to profit from it. The great swing comes perhaps a handful of times in a lifetime. When it arrives, only those who concentrate are positioned to capture it. The rest are distracted, chasing crumbs while a feast passes them by. Concentration is not recklessness. It is not gambling everything on a whim. It is the product of discipline, of patience, of waiting for the exact moment when conditions align. To concentrate is to recognize that the market does not reward constant motion but rare precision. Most days are not worth trading. Most moves are noise. The wise trader waits for the move that carries both clarity and power. And when it comes, he commits. The crowd calls him reckless. But he is not. He is focused. He has studied, he has waited, and now he acts with the full weight of his capital and his confidence. There is a reason why most men cannot follow this rule. Concentration demands courage. It is easier to scatter money in many places because each small position feels less threatening. If one fails, the others may balance it. The ego is protected because no single mistake feels fatal. But this safety is an illusion. The man who scatters never suffers catastrophic loss, but he also never achieves transformative gain. He lives in mediocrity, forever collecting crumbs, never sitting at the banquet. The forgotten rule teaches that greatness is not found in safety. It is found in the rare act of placing a bold, concentrated wager when the stars align. The market punishes timidity as much as it punishes arrogance. The timid trader nibbles, content with small moves. But when the great wave arrives, he has too little at stake to matter. He may be right, but being right with small size is as useless as being wrong. His account remains unchanged, his fortune unrealized, because he lacked the courage to concentrate. To concentrate is to marry conviction with size. Without size, conviction is wasted. Without conviction, size is suicide. The balance between them is the essence of speculation. History repeats this lesson endlessly. The men who made fortunes did not do so by dabbling in dozens of stocks. They did it by identifying the right move and committing to it with both hands. They did not flinch at the noise. They did not scatter their capital in fear. They did not hedge away their gains. They concentrated, and they endured. The forgotten rule is that true opportunity comes rarely, and when it does, you must strike with everything you have. Concentration also sharpens the mind. When you are spread across countless trades, your attention is divided. You cannot watch them all. You cannot think clearly about each. You are distracted, pulled in many directions, and so you miss the signals that matter. But when you concentrate, when you hold only what deserves to be held, your focus is absolute. You know every tick, every retracement, every clue in the tape. You become attuned to the rhythm of your position, and this intimacy gives you the clarity to act wisely. Scattering breeds confusion. Concentration breeds mastery. There is danger, of course, in concentration without discipline. A man who commits heavily without reason, without preparation, is a gambler, not a speculator. He risks ruin because he mistakes recklessness for courage. The forgotten rule is not an invitation to throw all caution away. It is a demand for precision. You must earn the right to concentrate. You must study, prepare, and wait. Then, when the rare signal comes, you must act without hesitation. The courage to concentrate is worthless without the patience to wait for the moment that deserves it. The market tests this resolve constantly. It offers endless small moves designed to lure you into action. It whispers that a little profit is better than none. It tempts you with noise disguised as opportunity, but the wise trader resists. He remembers that his fortune will not be made by these scraps. It will be made by the few great swings that change everything. Concentration means ignoring the distractions, holding back your fire until the true target appears, and then striking with full force. The crowd calls this dangerous, but the greater danger lies in never concentrating at all. To live in fear, to scatter endlessly, to avoid commitment. This is the path of slow death. The trader who never risks concentration will never know what it means to capture the full force of a market move. He will live in half measures, his account surviving but never thriving, his name forgotten while others carved their fortunes in the history of the tape. The discipline of concentration is also the discipline of restraint. You cannot concentrate if you are constantly trading. You cannot concentrate if you chase every flicker. You must have the patience to wait, the discipline to hold back, and the courage to commit fully when the moment comes. Most men fail at one of these steps. They lack the patience to wait, or the discipline to hold back, or the courage to commit. The rare man who masters all three becomes a legend. To concentrate is to recognize that wealth is not built by addition but by multiplication. Small scattered profits add, little concentrated moves multiply. One great trade, captured with size and conviction, can equal 100 small ones. But you only capture it if you are willing to risk focus. The forgotten rule is that the big money is not spread thin. It is gathered, sharpened, and applied with precision. In the end, concentration is not about the market. It is about the trader. It is about his ability to endure boredom, to resist distraction, to conquer fear, and to embrace conviction. The market will always offer opportunities, but only concentration allows you to seize the ones that matter. The crowd forgets this rule because it is easier to scatter, easier to nibble, easier to avoid commitment. But ease has never built a fortune, concentration has. The trader who remembers this rule, who waits, who prepares, who commits fully, when the time is right, holds in his hands the true power of speculation.